Let's talk depreciation recapture in a 1031 exchange. So depreciation recapture is an important concept for many real estate investors, especially when you are looking at 1031 exchange. On this lesson, we will explain what depreciation recapture is, how to calculate it, and then why it's important, and the concept of allowable depreciation. So what is depreciation recapture? Depreciation recapture is the process by which the taxes the gain realized from the sale of depreciable property to the extent that depreciation deduction were taken during the ownership period. When you sell a property, the IRS requires you to recapture the depreciation deduction by paying taxes on the amount of depreciation that you claimed over the year. So, why is depreciation recapture important in a 1031 exchange? A 1031 exchange allows investors to defer capital gain taxes, but it also affects the handling of depreciation recapture. So understand how it works is important. First, the tax deferral. So 1031 exchange defers not only capital gain tax, but also the depreciation recapture tax. So good news, right? The second thing is adjusted basis. The new property acquired in a 1031 exchange carries over the adjusted basis from the old property, impacting the future depreciation calculation. How to calculate depreciation recapture? To calculate depreciation recapture, follow these steps. First, you want to determine the adjusted basis. So you calculate the adjusted basis of the property, which is the original purchase price plus any capital improvements, and then minus the accumulated depreciation. The second step is to calculate depreciation taken. So you want to sum up all the depreciation deduction taken over the years. The third step is to identify the recapture amount. The depreciation recapture amount is the total depreciation taken up to the amount of gains realized from the sales. So let's look at an example. So we have the original purchase price of $300,000. Capital improvement is $500K. Accumulated depreciation assuming to be $100K. So our adjusted basis gonna be the 300K purchase price plus the 50K improvements minus the 100K depreciation. So that 250K is our adjusted basis. Let's say assume our sale price is 400K. So the gain realized is the 400K sale price minus the 250K adjusted basis, which is 150K. So in this example, the depreciation recapture amount is 100K, which is taxed higher than the remaining 50K of the capital gains. So right now, the depreciation recapture rate is your ordinary income tax rate up to 25%. So it's not counting as the capital gain tax rate that usually a little bit lower, right? So let's go by ordinary income tax rate. But it's at least they give you a cap. It's capped at 25%. So it's not too crazy, right? Because especially if you're a high income owner, your tax rate, your ordinary income tax rate might be say 37%, right? That is way high. So at least 25% is better than 37%. So let's talk about depreciation recapture and 1031 exchange. When you perform a 1031 exchange, the deferred gain includes both the capital gain and the depreciation recapture. So how does it work? It works by carry over the basis. So the basis of the new property is adjusted to reflect the deferred gain and accumulate depreciation. The second point is the continued deferral. So both capital gain tax and depreciation recapture tax are deferred until the new property is sold in a taxable transaction. For example, so say you own property, adjusted basis is 250K, the sale price is 400K, so deferred gain is 150. So that includes the $100,000 depreciation recapture. So let's say the new property has a purchase price of 500K. So your new basis is going to be calculated as you take the 500K purchase price, you minus the 150K deferred gain, that gives you 350. That's your new property adjusted basis. So the new property basis is reduced, allowing the depreciation deferral continue until a future taxable event. So depreciation allowed versus allowable. So this is an important concept, right? So usually if you think about depreciation allowed, is what the taxpayer had actually claimed on their tax return over the years. The depreciation that has been used to reduce taxable income annually. The depreciation allowable is the total depreciation that the IRS permits a taxpayer to claim on a property over its useful life, whether or not the taxpayer actually claimed it. This is the maximum amount of depreciation that can be used for a tax purpose. So how can this affect depreciation recapture, right? So when selling a property, the IRS require you to recapture the depreciation that have been taken over the years. So the recapture amount is taken at the higher rate, which is capped at 25% for federal, than the regular capital gains, which is the highest rate at 20% on the capital gains, right? So think about it. When you say sell the property, the IRS require you to have to do depreciation recapture, which is paying tax on the depreciation that you took. Say you have a property that if you, let's say for example, your accountant make a mistake. It was supposed to, your allowable, like the amount that the IRS allow you to tax depreciation on that property, say is 100K. But for some reason, the basis was messed up previously. So as of that day, when you sell the property, you add up all the depreciation that you took over the years, it's only 75K. You still have to pay tax on that 100K allowable depreciation. You cannot say, oh, I only pay, I actually took benefit only on the 75K that I actually took depreciation. So I'm only pay tax on it. No, the IRS make you pay back on that 100K. So what do you do at that point, right? The IRS is not recommending that you go back and amending all those years return. That too much work for you and for them. The way that you claim that 25K of difference, right? Because you're going to have to pay tax on that 100K anyway, right? So why not take the benefit of that 25K? Missed depreciation. Now, so the way that you do that is you're going to need to fill out the form 3115, which is the application for a change in accounting method. The purpose of this form is used to request a change in accounting and method of accounting used for tax purposes. So this might include changes how depreciation is calculated. So usually if you miscalculate your depreciation in the past, that you would use this form to claim those benefits. So you can see that depreciation recapture, this concept is very important for real estate investor, not just to reduce your tax annually every year once you have the property, but also it's play a big part in your decision. Either you're going to sell a 1031 exchange because you're going to sell, you have a gain, you know that you're going to have to pay back that depreciation recapture. But if you have if you do a 1031 exchange, you get to defer not just the capital gain part, but also the depreciation recapture part. This is really nice, right? With that, let's move on to our next topic.